Welcome back to my YouTube channel. So let's dive into today's topic. Hello guys, this is Poppy Joyfres and I want to welcome you guys back to my channel. So in today's video, I'll be talking about the liquidity stop hunt and how to use it in trading. So I'll be giving a comparison between aggressive entry and sniper entry. So let's call it this way. There will be a comparison between what we call confirmation entry and what we can call sniper entry. So I call the sniper entry the aggressive entry, and I call the confirmation the conservative entry. So let's see the difference between these two types of entry, using the liquidity stop hunt as a case study, as a main focus, right? First thing, let's identify what a stop hunt is all about. Stop hunt has different names. You can call it stop hunt. You can as well call it either liquidity hunt as well. It has a lot of names. Call it also liquidity hunt. You can as well call it, or hear people calling it, liquidity sweep. So it has a lot of names actually. So now, what does it really entail? Now, you see, every high or low, we have liquidity resting at a swing high or above an equal high. Okay, the concept of liquidity states that liquidity is everywhere, and liquidity is actually referring to trading orders, because if you check the forex chart, everywhere in the market we have what's pending orders or orders placed at every point. So you really can't tell the number of orders that we have at every price level. Over here now on this scale, or on this axis, right, I can see we have different price points and levels, right? But at each price levels and points, can you really tell the number of buy orders or sell orders, or maybe stop loss or take profits that is being placed at those levels? Really can't tell. So we say that our liquidity is found everywhere, but that liquidity can be found in certain areas more in abundance, and those areas are the ones I have explained here. So we can find liquidity above a swing high. So over here we have the swing high. Okay, and now what do you see price doing? A stop hunt action is price going to that place we have liquidity. So when we have liquidity resting above a swing high, and then price decides to go to that point of liquidity, and there's a rate on liquidity there. So the rate on liquidity we are referring to means price unable to close above that point. So how you can find liquidity is when you notice price trading to the high and failing to close above that high. This is what we call a stop hunt. Okay, most times this particular thing leads to a reversal. When you see price failing to close above your swing high, it mostly leads to a reversal. Okay, the opposite of this liquidity hunt or stop hunt, we call it breakout, or you can call it liquidity run. So in that case, that's when price breaks above a swing high or a point of liquidity. So in that situation, price just breaks and closes above. So when price closes above, it's a sign of continuation. So note the difference. Closing above is a sign of continuation, which we call a breakout. But when price fails to close above a swing point or either an equal high, it's a sign of what we call stop hunt, and that indicates a reversal happening. So we can have that happening at the swing high or also at an equal high like we have over here. So above this equal high, we have liquidity resting above it. Same thing below as well. Okay, below a swing low, liquidity is resting. Below equal low, liquidity is resting. All right. So the reason why we are learning about this is because you can actually use this concept to actually time and take advantage of reversals, because market now can be able to show you in advance. For example, when I see equal high, I can anticipate in advance that anytime equal high forms, we always expect a liquidity hunt to happen above it. So I could have anticipated that price is going to this place now to go and do a liquidity hunt at that point. Okay, that's based on assumption and anticipation for a reversal at that point because of the presence of liquidity. So what I'm about to teach you today is going to give you how you can trade this entry aggressively, and also how you can catch it with a much more conservative approach, which I call the confirmation entry. Okay, so let's check it out. So over here we have the aggressive entry approach, which is the sniper entry approach. So in the sniper entry approach, all you need to do is you have a point of interest, and you know that whenever price is close, or whenever liquidity rather is close to a point of interest. For example, I want to buy at this point, and we have price creating a swing low, which we know that at a swing low, liquidity is resting at a swing low. So my expectation could be that price is going to come there and do a stop hunt at that point. That means I'm expecting that price is going to come and do this action, taking out liquidity of that swing low and then tap into my POI for buy. So whenever you place a trade like this at this level in advance, hoping that price is going to come and take out this liquidity and use that to reverse, that is what we call the sniper entry, obviously, because at that point of grabbing liquidity, price is taking you in for your entry. So that kind of entry is always very, very sharp. We have limited drawdown on that kind of entry. And if price plays out, everything being equal, price plays out to your target, you make money and you're happy with little drawdown. Now, the reason why I'm teaching you this model is because I want to see the two sides of a coin. The advantage of this particular entry model and also the disadvantage that can come with it. In this other scenario as well, this is another example of an advanced structure actually, where we have internal liquidity, we have internal structure liquidity. So this liquidity also is present close to a POI internally. So when you also place a trade like this, with the assumption and expectation that whenever price comes to that liquidity, is going to do a liquidity hunt and tap into that POI. So in that case, you can see you have placed a pending order in advance with that assumption that assumption that price must take out that liquidity and must reverse. But what about if price gets to that point and there's a breakout instead? Remember, breakout indicates continuation. So if you had placed a trade here now and a breakout occurs and price just keeps on going down and keeps on going down, that would have resulted in a loss, right? And that could even be the case in most instances, that anytime you just mark liquidity and POI and price just keeps on breaking your liquidity, keeps on breaking your POI, and you're losing money based on this type of entry. So that is why I am teaching you another method of getting entries after confirmation. Now that method is much more, is going to require you to be more patient, because that one, you are not going to hurriedly start jumping on the trade at the point of the rate on liquidity or the stop hunt. And just so you be clear, this particular entry type is called turtle soup. Okay, I'm very sure you must have heard turtle soup if you are familiar with liquidity. This entry model is called turtle soup. And turtle soup is actually entering trade at the point of the liquidity rate. A lot of people have different meanings to it, but this is exactly the meaning of turtle soup. Giving your entry or taking your entry at the point of the rate. That means entry below the liquidity. That is what we call turtle soup entry. Okay, so this is the one that we call the aggressive or the sniper entry. Entering just based on assumption of a rate and not based on confirmation. So over here, I will show you the confirmation models you can now apply. So let's take a look at this guy right here. And let's see. I'm taking an assumption not based on a full picture, but based on a narrowed picture of things, right? Right here, we have this POI. And below that, above that POI, we have equal low, which, normally we can expect that when equal low forms near a POI, we can have a reversal at that point. So let me now teach you what we are looking out for here. So right here, we're expecting a liquidity rate as well, right? So right now, let's now assume that in advance, we are not taking a trade at the POI because we are not sure if there will truly be a liquidity rate or not. So in this case, we are going to wait for price to actually do the liquidity rate. Then after doing that, we'll now enter with certain confirmations. The first one of those confirmations is the sponsor candle confirmation, where I call the MSS plus RTO, that's return to order block. Right here, you see, the candle that is taking out the liquidity, right here, you're not entering at this point. Like I said, you are not doing sniper entry here. You are not entering at that point. So you either wait for price to come there and see what happens. Are we going to have a breakout, which can indicate continuation to the downside? Or we are going to have a stop hunt, which can indicate a reversal. So if a stop hunt happens here, and you want to enter, you're not also going to enter a trade immediately from the next candle and say, hey, it did not close below, let me start buying. Yes, we have traders that use that as their confirmation, but right now, the one I'm teaching you is a much more better confirmation, a much more reliable one, and that is the sponsored candle. Now, this is that candle that is taking out that liquidity. Mark out that candle. If that candle immediately has a fair value gap, even much better. In fact, in this case, there is a very good confirmation that is required here, and that is a fair value gap. Okay, that means after the sponsored candle you have here, there must be an imbalance immediately after. That imbalance is the one that confirms this candle to be valid. So what you do is wait for price to break structure. Okay, we are looking for a valid break of structure. And I've also made it clear, one of the things that also confirms reversal, like view reversal, is when you have a double break of structure. Yes, everybody knows that when price breaks the recent high, we call it a change of character or a break of structure. But to give you much more better confidence and confluence, when a double break of structure occurs, then you have that confidence in knowing that what the reversal is definitely certain. So right here, you are going to enter from the sponsored candle to the target this time around. So in this kind of entry, we call it the confirmation entry. or the much one we call the conservative entry approach. So yeah, you're not just jumping immediately on the buy because it's going to die. You are jumping after seeing the reaction there and also seeing the change in structure. That is the one for sponsored candle. Another entry model is a breaker block entry model. That means as price is also doing to the point of liquidity, price could also have a breaker block very much close to the so in this case as well, here we have a sponsored candle, but there are many instances, or market can come in different forms. So over here, when we have price doing something like this, that after price gets to the point of entry, and we have we can have an immediate mitigation of the breaker block. Okay, now just so you know, I made it clear in the meeting we had on the free space that if you have immediate mitigation of your breaker block, don't be so eager and happy to think your trade is going to go far. Okay, because most times that immediate mitigation of the breaker block forms an inducement, and price will later go below that inducement. And that's why I gave this scenario. Look at this. No, not this one. The one above here. Look at this. In this first one now, price came back immediately for the breaker block, right? But I told you, price will later go back below that breaker. So imagine you taking a trade from the breaker now and targeting the main targets, right? You could be surprised that price is just going to come back and break that inducement low that we had. So this is an example of an advanced structure. So I don't want to I don't want you to mess it up at all. Just understand this, right? If price comes to your breaker before going up, then trust me, price is coming down below it. And that second entry is the time you can now swing your trade to your targets. That's the one that will take price all the way to the targets. Okay? And all of this is happening after you have gotten the confirmation of the liquidity hunt. That's the stop hunt has happened already. That's where you can now start looking for entry based on structure like this. Okay? So the much easier way to now use the breaker block without price data coming back for this internal liquidity or POI is this. In any scenario whereby price has a breaker block, and above that breaker block we have an inducement before it, then trust me, when price is coming back, it will not be going into internal POI like in the first one I showed you. Rather, price is going to just stop at the breaker and use that breaker to go up. Now, I've equipped you now with a lot of information that, anything that market wants to offer you, you can actually tackle it as it comes. I also explained the reclaimed block model as well. The reclaimed block is quite simple as well. When you have probably a supply zone or a demand zone here, right? The price took out, look at this. There's a stop on here, right? Price took out the supply on this demand level. Like a zone that was supposed to push price to the upside. Like according to what we even have here, just imagine this. According to this structure here, right? Imagine price breaking this structure, what you can call a change of character. And you think price will come back to the other block here and continue buying. Now, what did price do? Price broke that demand and still went up. Now, that zone that failed initially, that zone is still valid. It's actually what? A demand zone, and it has failed. But that failed demand could still be reused, and that's what we call a reclaimed block. Okay? A reclaimed block means price can later come back to that same POI and buy from there to the upside. Now, a reclaimed block works best in cases where the sponsored candle itself might be somewhere very low. Let's say we have the sponsored candle like this, the other block is very low. So the immediate the reclaimed block here, the demand block here can actually serve as entry point for you to get your immediate entry. So this is another model for entry. So, and I believe with these models, you are definitely your trading game is definitely going to improve. So let's go ahead and see some examples on the charts. Alright guys, so let's take a look at this example on gold. Right here, we are price reading out liquidity. In fact, you can even take it as a trend line liquidity. I did not mention trend line, but then price has taken out this liquidity over here. Let me just put a line there to show the liquidity rate. And one of the entry models I've taught you is a breaker, right? So let's go to 5 minutes and find that breaker for that particular entry over there. So let's take it out. And you're going to definitely learn something from there. So right here, we have it at this point. This is the entry I'm talking about. So as the moment price is taking out the liquidity, what do you notice? The breaker block that's there, the exact breaker block we have at this neckline was immediately mitigated, right? So whenever you have price reading out your liquidity, price can use the immediate breaker block to go higher. That has been established earlier. And I told you, if price uses a breaker block, the low of that breaker block is an inducement. That price later come back below it, right? That has been stated as well clearly. That price later come back below that initial mitigation to another POI. Okay, so let's take it out and let's see when price came back below there again. So this on that time price now came back to the exact POI, going below the inducement. And let's see how we could have traded this one. So price also took out liquidity here, and let's see how the entry was. On the 3 minutes time frame, you will see definitely that was a breaker block entry here actually. So I want to just see it with your eyes. It was a breaker block entry. So at the point price is taking out liquidity, look at the breaker block pattern that was formed at that exact point, right? So the breaker block now, remember what I told you about inducement, right? The one that has inducement above. So look at this. After the inducement or after the breaker block here, the first pullback here is our inducement low, and price came back, add into that inducement, and I went to the POI and used the inducement to go high. In that case, I would not expect price to go lower to maybe a primary POI anymore, because price is going to use secondary POI now to continue going high. And that was what happened here. So another entry would have been taken here because I know that point is now protected and price is not going below it. So that would have given another entry all the way to the main target. And the main target on this trade is going to be the main external eye of the structure. Okay, because remember the structure right here is based off this particular one, the first inducement of this one, and all the way to the main eye, which is this external eye we have right here. So that point should have been the normal target for that trade, okay, if you have the mind to hold. All right, so let's take a look at other examples and let's see where entries could have been taken or how they have been taken using liquidity as a case study. So right here, we have another one based off the sponsored candle. So over here, it's clearly seen on, we can see price took out this internal liquidity that we have here. And it's part of the things I showed earlier. Let me see if I can show them on this particular tab over here. And then look at this particular entry model I mentioned earlier, the one of internal liquidity, right? So we have a POI and we have internal liquidity before it. This is exactly the example. This is the POI, this is the internal liquidity. So if you want to place your entry at this point immediately, that entry would have been taken as a sniper entry, right? The aggressive entry without confirmation. But right here, we actually wanted to enter with confirmation. So what do? You wait for price to read the liquidity, and then you wait for the structure shift. So right here, price took out this structure and, taking out the first eye, the second eye, giving us a proper shift in structure. And then price came back to the liquidity on the other block that was found there. Now that candle that was taking out liquidity is the one we call the sponsored candle. So the entry was taken from the sponsored candle all the way to the target, and that's a beautiful trade. Okay, so this is how you enter trades with confirmation. Okay, this other one here is based on the reclaim block, right? When I said a supply zone or a demand, look at this area here. This is a supply zone that failed. This was a fake out above that supply. So that same supply zone could be reclaimed. Okay, price came back to reclaim that same supply. And at the point of the reclamation, right, there's also this one is, you can actually call this one a sniper entry without confirmation, right? Because there's liquidity here as a reference, but then this is also reclaim block because it's direct. The reclaim block we have here is direct. Liquidity has already been involved already. So it's just a POI that we entered. But there's also a lot of liquidity before it that, we could have entered after the confirmation. And that would have been maybe after price broke this low we have right here. And if you want to use, I use line chart for confirmations too in most cases. So I would have used maybe when price breaks this particular low right here. And price came back for this key level. I'll use this particular key level here. Okay, that's it. So price came out for that key level. I could have used that as a confirmation. Normally, I will not use a key level or this line chart on the same time frame as the one I'm using for my key level marking. You understand? So, but there, this is just another method of getting a trade based on confirmation of liquidity being taken. There's another one I can see right here now. Price took out liquidity here and came back to the candle that took out that liquidity. That's a sponsor candle, right? So this is another example of how liquidity can be entered with confirmation, not entering it at that point of the day, because you might not really can tell which of the lows will be taken or which one of the highs will be broken out. You really cannot tell most times that, okay, maybe price is going to read this one or is going to read this one. So rather wait for price to do its thing, then you enter after it has done it. So that's a much safer entry model. Okay, let's see more examples. Right here, there's a breaker entry here as well. I don't know if you can see it. This is price taking out liquidity clearly. And this is a breaker block, right? So that breaker block is what price came for. This is the inducement before it. So that's another entry from that POI to the downside. I think I have another one right here. I have another one right here. So this one was visibly seen on 1 minute doubles. I'm sure you are wondering how I'm able to pick this liquidity, maybe not the same way you would expect to see it. And that's because of experience and knowledge, right? Okay. Mostly if you're looking at it in terms of highs and lows, we have gone further to look at it in terms of candles alone. And that makes us even much better and simpler to see. Okay. So let's see what else we have. We have price taking our liquidity right here also. By the time you check on 1 minute, you'll find the exact sponsor candle that we have there. The price came back for the entry and many, many more like that. So this is exactly how you can enter trades with confirmation, not open and anticipating that at this low here, whenever price comes there, it's going to break it like this. No. It's just after the thing has happened, then you enter. It's a much safer approach and it also forms a very good strategy if you just know how to use it. So thanks for watching, guys, and I'll see you guys on the next one.